Hey folks, welcome back to the channel. This is the last trading session of the week, April 25th, and on last Tuesday, I mentioned it was likely the market would go down over the next week, which it did, to reach the bottom of this channel, and now it's come all the way back up to the top of this channel a fourth time. And I mentioned in last week's video that I will remain bearish as long as the price action stays within this bearish channel going down. However, yesterday, marked by this green candle over here, the S&P 500 broke out of the channel a little bit, closed just a few points higher, and we got follow through today. But as I mentioned before, this is not a real reason to be bullish just yet, because we need to wait for the price to come back down to retest the top of this channel. And if it goes back in, then that's bearish. But if we see the price bounce off, then that would be a bullish sign. You have to be very careful around here because although it might look like this is a breakout with the 1, 2, 3 failed attempts before, and then the bulls finally succeeded the fourth time, it's very possible that this is a false breakout setup where the market makers convince everyone that the bear trend is over and now we're going to see higher prices, which in turn will make a lot of people buy at this point. And shortly after, the market makers drop the price hard, and all the people who got in around here will be losing money, at least on paper. So gotta watch out for liquidity pool traps. But for now, I'm pretty neutral on the market. I don't really have a bias going into next week in either direction. But I do think that the S&P 500 will likely outperform gold over the next month or so. So I'm going to put in a trade that's going to take advantage of the change in the relationship between gold and the stock market. So if I want to see the performance of gold relative to the stock market over time, in TradingView, I can type the ticker for the Spider Gold ETF GLD, and then /SPY for the ETF that tracks the S&P 500. So both of these are ETFs, and it's going to give us a chart giving us not the price, but the ratio of these two. Now, the reason I say I think the stock market will outperform gold is because if we go to the weekly chart, you can see that there has been this massive run up in this ratio. And that just means the price of gold has gone up and diverged significantly from the S&P 500. Now, the question is what happens after an event like this takes place? Well, if we go back to 2020 on this weekly chart, you can see that a massive run up in this ratio has led to a precipitous fall later on. Zooming out a little bit more, we can see that all the way going back to 2005, you have these peaks followed by troughs afterwards. So this strategy is meant to take advantage of these downward retracement times where gold falls in price relative to the stock market. And the question becomes, how do we know when to enter? Well, if we take a look at the RSI, which is this purple chart down here, we can see that there has been only a few times in the past 30-year history where the relative strength went above 80, which is very high. That happened over here in 2020, over here again in 2011, and back here in 2006. Of course, it's not going to stay up that high above 80 for very long. So when the RSI drops back below 80, this ratio between gold and the SPY typically goes down over the next month. So we have the RSI go above 80 over here to 83 point something on the week of May the 8th, 06. And then the next week, May the 15th, the RSI dropped back below 80, and we can see the ratio started to fall. So gold fell in price relative to the S&P 500, and that continued for another 1, 2, 3, 4 weeks. Now, the next time this happened when the RSI went above 80, this was pretty close in 2007, but it didn't quite get there. It was in 2011, and looking at the RSI, it went above, went below. This was on the week of August 22nd. Let's see what happened to this ratio. We got a red candle, and over the next 4 weeks, 1, 2, 3, 4, the bars moved lower and continued to drop after that. Finally, if we go towards the right, we can see it barely happened again on the week of March 16th, 2020. The RSI went above 80 and dropped right back down afterwards. So if you made a trade here, shorting this relationship at the end of this red candlestick, and you just held it for a month, you would have made money over the next 4 to 5 weeks, and potentially more money if you held as well, just like the previous time. So that kind of brings us to today, where this rare phenomenon just happened. In this case, you can tell gold relative to the SPY is really overbought because the RSI went above 80 and stayed up there for quite a few weeks. It was above 80 for 1, 2, 3 weeks. However, this week, ending today, in like the next 19 minutes, it's pretty safe to assume that the RSI for the end of this week is going to drop back below 80. So this triggers the entry point of getting in with this trade. Now, the way this works practically is you would have to put in 2 trades, one to go long the SPY and then another trade to short GLD. And you can do it with options or directly with the ETFs themselves. And you have to put in those 2 trades separately because as far as I know, there isn't a gold to stock market relationship fund that's readily available. So on my order entry form, I'm going to buy 10 shares of the SPY.
Order filled.
And that's at about $550. That's going to be $5,500 long the stock market. And then at the same time, I'm going to choose the Spider Gold Trust, GLD, and I'm going to sell that. So I will be short this. And for the position, I'm going to choose 20 because 20 times the current price of GLD, about 300, will give me $6,000. And that is roughly equivalent to the 5,500 long position that I have in SPY.
Order filled.
Okay, so I bought 10 SPY and I sold 20 GLD near the end of the trading session on April 25th. And the strategy is to hold this for 4 to 5 weeks. What will likely happen is that this ratio will go down, meaning the price of gold will fall relative to the price of SPY. This is what happened in all of the times after the RSI went above 80 and then fell back down over the last 3 decades. So there's a good chance it'll happen again this time. And then after a month, I will look at this position again and maybe sell half of my trade and then leave the rest for another month and then reassess what's happening to this chart. If it looks like it's bouncing off like a support line, for example, this line here, and then it starts going up again, then I will probably get out of my position and take a profit. But the reason I don't want to completely get out of this trade after the first month is because I want to leave some runners just in case this trend continues to go down, which is very possible, especially if it goes down for an extended period of time, like what happened back in 2020. The good thing about this strategy is you don't necessarily need the SPY to go up and you don't need GLD to fall. You can make money if they both go up or down, as long as SPY relatively outperforms GLD. So we'll see how this goes. I'll give you guys an update after a few weeks. Thanks a lot for watching, and I'll talk to you in the next one.